Hello, this is Bob. On this lecture, we will continue on Chapter 12. We're going to talk about the withdrawal of the partner. So we talked previously about the partner being added to the partnership. Now we're going to talk about a partner leaving the partnership. We'll go start off with an example. So a partner leaving the partnership. At the date of the withdrawal of Perez, the partnership have the following capital balances. Perez had $38,000 in the capital balance, Zane $84,000, Rashid $38,000. So those are the capital balances. In their capital accounts, the partners share income and loss equally. Perez is to receive $38,000 cash upon withdrawal from the partnership. So the easiest thing that could happen when a partner withdraws is to leave for the amount that is in the capital account. And that's what's happened in this case. If we look at the journal entry, we would say, is cash affected? Yes, cash is affected for the partnership because it's going from the partnership to the partner. Therefore, it's going down. How do we make something go down? We do the opposite thing to it as what it is. So we're going to credit cash because cash is a debit balance. We're going to make it go down with the opposite thing with the credit. And we're going to debit another account. And the other account we're going to debit, in this case, is, of course, the capital account for Perez. The capital account represents the amount of money owed to the owner on a book basis generally. And in this case, the company is paying that money out. Therefore, that capital account needs to go down to zero in this case. How do we make something go down? We do the opposite thing to it as what it is. Capital accounts have credit balances. The opposite thing to it as what it is would be a debit. Therefore, we will debit the capital account. All right, next scenario. At the date of the withdrawal of Perez, the partners have the following capital balances. Once again, 38 for Perez, Zane 84, and Rashid 38. The partners share income and loss equally. Perez is to receive $34,000. So now the issue is the capital account is 38, and the partner is going to pay out 34. So there's a difference there we're going to have to account for. And so we can think about what happens to cash again. Is cash affected? Yeah, cash is still going down. How do we make something go down? We do the opposite thing to it. In this case, would be a credit because cash has a debit balance. We're going to do the opposite thing to it to make it go down. And therefore, we're going to credit cash for the $43,000, the $34,000 cash paid out. And then we're going to take the capital account off the books. So just like before, the capital account Perez is on the books. We have to take it off for whatever it's on the books for. So it's on the books for $38,000. Perez is gone after this. Therefore, we need to take it down to zero. So we're going to do the opposite thing to it. It's a credit balance account. We're going to do the opposite thing to it to make it go down, which is a debit. We're going to make it go down to zero by debiting it for the amount in that account. And then the 38 minus the 4 means that we have a $4,000 plug that we need to apply somewhere in order for the debits to equal the credits. And we're going to allocate that equally between the capital accounts of the remaining partners. So in this case, the capital accounts of the remaining partners are going to be increased because we're crediting those capital accounts in order to even out our journal entry. So capital accounts have a credit balance. We're going to make it go up by doing the same thing, which is a credit here and a credit here. Now the total debits equal the total credits. Next scenario, at the date of the following withdrawal, Perez, the partners have the following capital balances. So now Perez still has the 38, and the Zane the 84, and Rashid 38. The partners share income and loss equally. Perez is now getting $40,000, however, and therefore Perez is getting more than the amount in the capital account. And we'll have the same type of transaction. Once again, cash is going to go down. So how do we make something go down? We do the opposite thing to it. So I would always start with cash, even though it's on the bottom of this journal entry, because it's the easiest thing to think about most of the time. And we're going to make it go down by doing the opposite thing to it, which in this case is a credit. So we're going to make it go down by the amount that is paid out, which in this case is the 40. Now we're going to take Perez off the books. So remember, we're just going to take Perez off the books for whatever Perez is on the books for, because we don't want a capital account at all that says Perez on it, because Perez will be gone after this journal entry. So that means if Perez is on the books with a credit of $38,000, we need to make it go to zero by doing the opposite thing to it. For, in this case, that would be a debit of the $38,000. And then we have the difference of the $2,000 in this case would be a debit to the capital accounts here. So notice what that does. We're going to split it evenly between the two remaining partners in order for the debits to equal the credits. And that will reduce their capital accounts because capital accounts have a credit balance. We're going to make it go down by doing the opposite thing to it, which in this case is a debit. So these remaining partners had a reduction in their capital accounts, which is basically the book value owed to those partners. Okay, so the death of a partner, a partner's death dissolves a partnership. A deceased partner's estate is entitled to receive his or her equity. The partner's agreement should contain provisions for the settlement. These provisions usually require, so this is of course the scenario, what if a partner dies? Then the estate, the accumulation of their assets, should receive his or her equity in the partnership. So these provisions usually require closing the books to determine income or loss since the end of the previous period. So we want to close the books so that we can figure out what the amount should be, determine and record in current market values for both assets and liabilities. So we talked before about things like depreciation. We talked about fixed assets not being at the market price. So we might have property, plant, and equipment that is being depreciated. When we close the business, we need to revalue those assets and liabilities to the current market value so that we can properly pay out what is due. So we'll have to actually probably get appraisals and whatnot on the company assets and liabilities to see what the true value is. Then we can readjust the capital accounts. Then we can pay out the partners in a fair way. Settlement of the deceased partner's assets can involve selling the equity to remaining partners or to the outside, or it can involve withdrawal of assets.